This just got much worse. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, severe problems are now surfacing under the major banks, indicating that a severe credit crisis is now in the beginning stages. We're going to take a look at what's going on with the bank balance sheets and why this is a leading indicator of not only more financial stress, but a severe credit crisis that could be in full bloom in a matter of months. But yet some new reports from the government. Yes, the government of all places is now suggesting the economy could be in far better shape than we thought. We'll put that to the test as we then compare what's going on with the banks to what the government is telling us is really going on. And we've got one expert who will blow you away. You'll be surprised about who this is, telling us that a recession is now baked in the cake and only a matter of months away. And we're going to show you why we think he's right. Let's over to FreightWaves, where he picked today's story up with a headline. Weak truck market finally shows up in BMO Transportation Group's quarterly report as write-offs are up and provisions for credit losses are soaring. Now, what's important about the story and why BMO matters is because they do a lot of lending to the transportation sector. So when they start to see stress in the system there, where you see start to increase delinquencies, increase write-offs, and you see increased credit provisions, what it's telling us is the global economy is slowing down, because what you want to see is as trade increases, transportation increases. So in this case, if trade is decreasing and transportation slowing, that means the marginal carriers, the marginal businesses are all going to get washed out. And BMO, which is kind of unique from a lot of the other banks, actually segments this out for us to see the numbers, and they're not pretty. Allowances also showed a significant increase in the second quarter in the transportation group. This again in the bank's balance sheet. They rose to 17 million from 10 million. It was the highest number since the fourth quarter of 2021, when they were also at 17 million. But they note they're still well below the 30 million and more figures that were recorded in 8 consecutive quarters between 2019 and 2021. Now, what do we know going back to, of course, to 2019? The global economy is slowing. So what are we seeing now is that slowdown is starting to gain steam again. This is what everyone's telling us was not going to happen, that we're going to have a second half rebound. Maybe the Fed, as they're suggesting, a no landing, but the transportation sector now is telling us just the opposite is likely. To highlight how significant the most recent quarter was, they take a look at the transportation book. Even when it posted a 38 million provision for credit losses in the second quarter of 2020 during the heart of the pandemic, the quarterly figure rose only from 29 million, or a 31% increase. Get this, by contrast, the jump to 18 million in the latest quarter, and I know it doesn't sound big, from 6 million in just 3 months marks a 3x jump. Now, what's important here, that 300% increase is really what matters. Sometimes it's not the size of the increase, it's the rate of change, which is the same case for making in those initial claims for unemployment. When you come off very, very low numbers, it doesn't take a whole lot to get the ball rolling in the wrong direction. This case, we're seeing a threefold increase in those write-offs, or not write-offs, but what the provision for credit losses, which means it leads to write-offs. So again, when banks do credit losses, they're increasing their provisions. They're trying to believe that these loans are going bad. They have to hold money aside, because write-offs, look at this, we're up 250% to 10 million. So that is a huge number. And impaired loans, these are loans that banks think are actually going to fail. They're not sure, but they have signs they're going to fail, as gross impaired loans climbed to 91 million from 82. Now they want to note here that the bank actually were at 105 million as recently as the third quarter of 2021 and peaked at 189 million in the second and third quarters, suggesting that the current number is rather low. Again, it's the trend that is changing now. The cycle is shifting. If we were in a booming economy or we're in a phase of expansion, we should see these numbers decreasing, because there's enough money flowing, enough prosperity, enough trade to say that not all of these people, these businesses, are going to go under. And now we're seeing just the opposite. And why is that? Well, it's simple. Trade here, according to the trade balance of goods and services, looking at the balance of payments data from the U.S. government, says what's happening with trade? It's going the opposite direction. You can see the trend is saying, hey, look, trade now is shrinking. What does that tell us? The global economy is shrinking. What does that tell us is happening in the transportation sector? It should be shrinking. What is BMO telling us? Look, we did a lot of loans out to this group, and now a bunch of them are going to be dead loans. They're going to default. We're starting to prepare for it. We're seeing the delinquencies. We're doing the write-offs. It's telling us everything we need to know, and it's validating because this is not something that should be happening. But the government says not to worry. Perhaps the economy is in far better shape than we think. As U.S. consumer spending jumped in April and inflation accelerated, the question is, why was spending up so much? Well, it rose 0.8% in April, boosted by higher spending, get this, on vehicles and services such as insurance and healthcare. So when you think about, discretionary spending driving the economy, you don't think about things like insurance and healthcare. Those actually take money away from discretionary spending, and that means people were forced to spend more on insurance and healthcare. But the question is, did you experience that? Leave us a note in the comments. Did your bills go up? We'd love to know that, because April's report came in after 2 months of weaker spending, suggesting that perhaps insurance companies are finally getting around to raising their rates. Adjusted for inflation, consumer spending rose 0.5% last month. Again, all healthy numbers on the headline. The Fed's preferred gauge of consumer inflation, the Personal Consumption Expenditures Price Index, rose in 0.4% in April from the prior month and actually moved a little higher to 4.4% from a year ago. Excluding volatile food and energy, the core PCE also rose 0.4% in April and 4.7% from a year earlier, suggesting that inflation here remains sticky for the time being. Are we still likely to see inflation come down? Yeah, well, we'll make the case that it is, but it doesn't always go in a linear fashion. We seem to kind of be in a pause here where inflation appears to be sticky. This starts to set up the notion that mid-June, what might we see? Well, we could see an increase in rate hikes from the Fed. Because the Fed is actively trying to slow the economy, but if something doesn't work, well, what you should do is do some more of it, because the Fed's increased interest rates 10 consecutive meetings since March as it tries to slow the investment spending and hiring to reduce high inflation. Friday's report offers clues on the extent to which the central bank has more work to do with inflation, or suggesting the fact that rate hikes actually don't do anything to bring inflation down. But we won't say that too loud, because the Fed absolutely does not believe that. In fact, many consumers don't believe it. All we're seeing is more rate hikes until the financial system breaks. When that breaks, well, then we'll have all the deflation that the Fed can handle and more. As some consumers pull back, we're seeing retailers. Again, you're seeing some things that kind of validate the BMO story. The retailers say inflation pinched consumers are pulling back, with companies such as Best Buy, Dick's Sporting Goods, and Kohl's recently flashing mixed signals on the health of the consumer. Even Home Depot has said spending on home improvement cooled sharply this year. So we have a bit of conflict here, and we're going to get into some more data in a moment, suggesting that, hey, something isn't adding up. Transportation slowing, spending slowing, but for some reason, the government numbers are looking good. But one thing that also should look good, well, that's your trading account, because you may see this recent move in tech stocks that everyone now is chasing to the upside. How would you have liked to buy way down here at the low? And if you miss that, how would you like to buy in here? Well, our CTA-Timer Pro report that looks at the machine positioning, runs a historical overlay. Look at this. Back in January 9th of 2023, pull up your charts, look at QQQ. It gives you the very first signal that the machines are short covering, your very first signal that you should start buying into this rally right there near the lows. And if you missed that, we'll fast forward to March 15th, where the second opportunity hit, where again, the report suggested buying by the machines was occurring and that you should start building positions there. The link to the report is in the description below. It's only $30 a month, but you can see it nails these moves every time. Check it out. 30-day money back guarantee. When we look at personal consumption expenditures, how do we know they're coming down? Well, they're fairly tied to crude oil. Now, I know you're looking at this chart saying, Steve, this is a bit of a stretch. These are too noisy on the crude oil. But what's important to understand is personal consumption expenditures typically ranges around 4 to 6% a year. So we're getting down into that normal range. What crude oil is trying to tell us, you see this red line pushing down, is saying, look, these personal consumption expenditure numbers are going to come down a bit. They are going to moderate at the level that they need to be and have been historically. It's just a matter of time before it pulls it through. You can see here back during the dot-com bubble, the crude oil and year-over-year rate of change declined, and it took a while for the PCE to follow, but it eventually did. But one thing that's looking better is personal incomes. If you want to see a chart here that suggests that perhaps things are actually better than they appear, this is the one chart that actually does indicate that perhaps consumers really have enough money to deal with inflation. Now, I know some of you are shaking your head right now saying, absolutely no way, that's not true. But I just want you to see from the government's perspective what they're saying. And here we have personal income in blue, and then in red, we're adjusting it for the consumer price index, inflation adjusted personal income. And what I want you to note is heading into recessions, what do you tend to see? You see both of them trending down. So personal income is slowing, and you see inflation adjusted income is slowing, meaning consumers have less money to spend. And that's exactly what we would expect to see. You see it over and over again. The dot-com bubble, the global financial crisis. You see almost a double dip recession. You almost see the 2016 global recession that was starting to build. And now look, you see both lines headed higher, suggesting that perhaps for the first time in a long time, consumers are starting to get ahead of inflation. But will it last? That's the question, because the popular belief right now is consumers are sitting on a huge pile of money still from the stimulus. Let's take a look at this next chart, which perhaps suggests that that may not be the case at all. Here we have the personal savings rate, which has come off very, very low numbers here. We're seeing perhaps decades low numbers, and now suddenly it's building up, indicating that consumers or workers are saving more of their paycheck. But notably, when I overlay deposits at all commercial banks on a year-over-year rate of change, what you see is a big crumbling of deposits, and it's even gone negative here, as you can see on the right side with the zero bound kind of right about there. And so what it kind of tells me, there's two ways to look at this chart. You can either say people are moving money out where it doesn't show at the commercial banks to other banks where they're earning higher yields, or what it's suggesting, as we perhaps know, is that consumers are spending down their stimulus savings. They've been doing that, and now they're going negative as they're having trouble keeping up with inflation. And even though wages now, for the first time, according to the data, are starting to get ahead of inflation, it doesn't mean consumers don't have a lot of debt. And we note that from the credit card data. So it's possible we'll continue to see a decline in deposits here, as of course, higher prices still weigh on consumer spending. The question is, what do you think? Do you think the government data is right and we are coming out of this and everything's going to look okay? Or do you think some of the credit data is right and that we're headed into another crisis? Would love to get your feedback, because one place that suggests things may not be quite as good is Dollar Tree. Its Dollar Tree shares plunge after company misses on earnings, slashes full-year profit outlook, and while their net income for the 3-month period that ended April 29th was about $300 million, compared with $536 million a year earlier. Talk about some stimulus money here. Look at this. Same-store sales were up 4.8%. That is interesting, because what you have here is a story of Dollar Tree being squeezed at the margin. They have sales are up, but their profits are down. Their earnings and profits are down, suggesting is consumers aren't spending as much money. They're not doing as what they need to do. But we know, of course, stores like the Dollar Tree tend to benefit during periods of high inflation as consumers look to stretch their dollar a bit further. But notably, what we're seeing here is just kind of what we know. Consumer spending is slowing, and that's not an indication of a booming economy. But one place the government turned around today and said, well, maybe not so quick, was the durable goods new orders. Core durable goods new orders see annual decline as investment proxies soared. The durable goods were expected to decline 1%, but instead rose 1% after March was revised down from 3.2% to 2.8%, suggesting that, again, orders are looking pretty good. But when you strip out the noisy transportation sector, it tells you they are outright flatlining and almost a slight contraction, both on a month-over-month and year-over-year. And that kind of validates kind of what we see here. And when we look at the Philly Fed data, which of course we're looking at new orders against the government headline data, and what we know is new orders data on the Philly crashed deep into negative territory. But what happened is the government data didn't. In the past, it usually does, and it's starting to bounce higher and follow the Philly Fed up. I don't know what you think, but my guess is we're going to see a reversal here, and this trend in new orders is going to continue to slow, particularly as retail inventories remain high. But one expert says a recession is coming and could start this month, as we are already slowing. But who is this? Well, the developer of one of our favorite indicators, the developer of the yield curve. Harvey added that a downturn could last 2 to 3 quarters and placed the blame on the Federal Reserve's aggressive rate hikes, calling a recession a self-inflicted wound by the central bank, which is exactly what we've been suggesting. He also warned about the effect of the Fed's tightening campaign on the bank sector, which has seen a string of failures among regional banks. So again, he's saying here, look, Fed, you're the ones that are inverting the yield curve, and the yield curve is a phenomenal predictor of financial stress and recessions. And look, you're the ones that are damaging the banking system. You just can't see it. These are all the things that we said on this show. And when you sharply invert the yield curve, it puts stress on the banking system, exactly as we've seen. I believe that our risk to the banking system is much worse than people believe. Of course, as you know, I completely agree with that sentiment. And if the Fed raises rates again in June, well, at some point, we're going to see a whole lot of fireworks in the banking system. In periods of economic growth, short-term bills will provide lower yields than long-term ones, as it's designed to do, as investors are more eager to bet on the near future. But he says when these yields invert and 10-year treasuries gain demand over short bills, it signals economic uncertainty. He notes in the past 8 inversions that a recession has always followed. Here you can see the 2-year, 10-year yield curve chart we use all the time, suggesting that this deep inversion in the curve, which is largely due to the Fed, will ultimately end up in a recession at best, an all-out financial crisis at worst. But one thing that's almost seemingly wrapped up now is the emerging U.S. debt deal would raise the limit, cap spending for 2 years, and it looks to be a deal will be done somewhere over this weekend, perhaps, with the House signing on Tuesday. And as we suggested, the drama around this will quickly subside as both parties, in the end, knew they had to come together and make concessions to get this deal done. But will it even matter? Because the economy at this point is already slowing down. It seems to be too little, too late. But I guess soon we'll find out. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.